Okay, dear students, this is Mustafa Mirchawala, your SBR trainer from Mirchawala's Hub of Accountancy. And today we are going to start one more past paper, the latest past paper of September, December 2023 attempt. Question number 3. September, December 23 attempt. Question number 3. Okay, right? And definitely the objective of the session is again to give you guys confidence and give you exam technique that don't go for perfection, go for maximization. Go for maximization. Very simple. Very, very simple. Don't try to complete everything. Don't try to master everything. You should go for the max, right? Okay. And the same approach we'll follow. Now, what I will follow in this question, I will explain you this question, and after this question, I'll invite you to send me your scripts. You can send me your scripts, right? Okay, for marking, and I'll mark this question for you guys. Okay. Jacinta company is the parent company of a group. Jacinta company is the parent company of a group. Its main business is in the telecommunications sector, but with the continued expansion of products and services, it has also developed a credit risk management business. The, the financial year end is 31st December x6. So keep this thing in mind that our normal business was telecommunication, but now we are buying the credit. We are also buying the financial instruments. In simple words, we are buying the financial instruments. Okay. So the financial year end is 31st December x6. The functional and presentation currency of Jacinta company is dollar. So our currency is dollar. Okay. So in this question, there are total three topics, three things will be covered. Number one is the IFRS 9, that ECL, expected credit loss thing, impairment thing of IFRS 9. The second thing which will be covered is IFRS 15, the revenue thing, which is easy, not difficult. And the third thing is a little bit of foreign subsidiary and P2S sale, right? Okay. Now, so in the nowadays the latest question are in the form of portfolios. So they have given you some, sorry, the latest question is in the form of exhibits. So they have given you like few exhibits, which I'll move the screen and I'll show you. Okay. So number one is related to loan portfolio, describes the purchase of credit impaired loans by Jacinta company. Okay. Now, what's the first requirement? Explain how Jacinta company should account for the credit impaired loans in the financial statement for the year ended 31st December x6. Your answer should include journal entry C. So you need to do the practical plus theory both. You need to discuss practical plus theory both. Okay. So leave the other requirements right now. It's not needed. Let's go to the first thing. This is the area C. Jacinta company purchases credit impaired loans. Jacinta company purchases credit impaired loans and measure these at amortized cost. Jacinta company correctly calculates the loss allowance as the changes in lifetime expected credit losses since its initial recognition of the asset, which is effectively the changes in estimated cash flows. Okay, so this is the routine process. This is the routine process which they have told you. As you guys already know, that after the introduction of this IFRS 9 expected credit loss model, you don't have to wait for the collision with iceberg. You don't need to wait. You have to book your credit losses before. You have, like, it's more towards prudence concept. Now the latest approach is more towards prudence concept. Okay, so you can book it immediately as you feel there are some problems, as you feel there are some problems. And still, you know, there are three stages: stage 1, stage 2, and stage 3. Stage 1, stage 2, and stage 3, right? Stage 3 is like pure bad debts written off, but stage 1 and stage 2 is like allowance. Stage 1 and stage 2 is like allowance, right? Okay, and see what they have written here. If you read, Jacinta company correctly calculate the loss allowances as the changes in life expected credit losses since initial recognition of the asset, which is effectively the changes in estimated cash flows. So obviously, see, I have given loan to somebody. I have given loan to somebody. So with respect to time, like right now, I expect that they will give you complete amount. Okay. So everything is fine. But there is a possibility after year one, the expectation changes. The expectations changes. The guy is in front of me is not stable now. So if there are changes in expected future cash flows, so this will give rise to impairment. This will give rise to impairment. They will follow this. Okay. Now on this was the general thing. On 1st January X6, Jacinta company bought credit impaired loans. Credit impaired loans. See, this word itself says credit impaired loans. That means already these loans are doubtful. Already these loans are doubtful. Like you think already some party has some party has given loan to other party. Mr. X has given loan to Mr. Y. Now Mr. X is not satisfied with Mr. Y. Mr. X is expecting that Y performance is not good. So we go to Mr. X, we go to Mr. X, our company, and we said, okay, we'll buy your loan. We'll buy your investment. Investment means loan receivable. We will buy your investment or loan receivable and just take this 50% amount from us or 70%. Okay. Definitely, as we are buying a defected loan, as we are buying impaired loans, so obviously we'll give less price. We'll give less price. Okay. Let me say this thing in Urdu Hindi language because some students are Urdu Hindi. So I will use some phrase in Urdu Hindi language. Listen. हम जब एक ऐसे बंदे का लोन खरीद रहे हैं जो खुद तबाह हुआ है, ऐसे बंदे का लोन खरीद रहे हैं जो तबाह हुआ है, यानी सामने वाली पार्टी बहुत बुरे हालात में, तो हम ऑलरेडी प्राइस कम पे करेंगे, कम प्राइस में खरीदेंगे. इम्पेयर्ड लोन है ना, ऑलरेडी तबाहशुदा लोन है, राइट? So as we are buying this defected loan, so we'll give less price. Okay, so initially, just think, initially all the impairment, all the bad things is already included, already priced in your initial price. Whatever price we are paying is already after deducting all impairment, is already after deducting all impairment, is already after deducting all impairment, right? Okay, now that means just give a message to your mind that we have already bought an impaired product. We have already we have already bought impaired product. That means in past already impairment has been done. Just give this message to your mom. Now Jacinta company paid 32 million, which is equivalent to fair value. Okay, so first of all, we'll make the entry loan asset debit or financial asset as you wish, whatever you want to write. 32 million and bank or cash credit 32 million. Okay, so this is the first entry. This is the first entry we'll be making on 1st January X6. This is the first entry we'll be making on 1st January X6. Okay. Now they are saying the remaining, you need to be very active. The remaining contractual cash flows expected to be received on 31st December each year are, see, right now we are at 1st January X6. So by the end of December X6, we will be receiving this X7, X8 and X9. 4 years we'll receive 8.8, 8.8, 8.8 every year. Okay. The credit adjusted effective interest rate. Yes, this is very important. This is very important because you will see here that we are using amortized cost. See, check the top of the screen. Check the top first line of the screen. We are using amortized cost. So in amortized cost, effective interest rate is very important. Amortized cost accounting, effective interest rate is very important. In amortized cost accounting, effective interest rate is very important for the amortized cost schedule and impairment and everything. Okay, now So these are the credit adjusted effective interest rate on the above cash flow is 3.9% per annum. During the year ended 31st December X6, 8.8, this is 8.8, right? 8.8 million was collected. Excellent. In the first year, by the end of the first year, we received what we were expecting. Okay. At 31st December X6, the credit worthiness of the loan has improved. Improved. Good news. Good news. Good news. Jacinta companies expect the following cash flows to be collected. See, the cash flows has been changed. The cash flows has been changed. So this question is basically, it's like a reversal of impairment question. This question is basically a reversal of impairment. Like in this question, I'm gonna calculate gain. I'm gonna calculate gain. I'm going to calculate gain, impairment gain. As a student, you may ask this question, sir, are we allowed to book impairment gain? Yes, because in past impairment has done, we have already bought credit impaired loan. That means in past a lot of impairment has already booked. In past a lot of impairment has already booked. So if you have booked the impairment, you can do reversal as well. You can do reversal of impairment as well. And in past, when you booked impairment, it was expense. When you booked impairment, it was expense. So now the reversal will be your income. The reversal will be your income. So just don't do any panic. Just think it as a normal question. Just think it as a normal question and see. We were expecting before we were expecting this and this. Obviously this year has passed, this and this, these three, but now we are expecting this and this. So what you have to do is just calculate the present value using old cash flows. Just you have to do is to calculate present value using old cash flows and then present value using new cash flows. So you will get simple impairment reversal. You will get simple impairment reversal. Okay, giving you 30 seconds or 1 minute to read it. Obviously you need full time focus for this. Please read it and then I'll move the screen. Please read it again. Don't, no issue. Okay, so now first of all, give this message to your mind. Give this message to your mind. 1 year, 1 year has just passed in front of us. 1 year has just passed in front of us, and in this year one, we simply collected first 8.8 million. Okay, and definitely, as we have given loan, as we have invested in loan, so we'll be booking interest income as well. So in the first year we need to book interest income using effective interest rate, okay. Same with the four column approach, and then by the end of the year we will be doing reversal of impairment. Don't worry, reversal of impairment. Now listen, let me use the same word, amortized cost brought forward opening. So you have then interest income, then you have cash received, right? And then amortized cost carried forward, right? So these are your four columns. These are your four columns. So first of all, at 1st of January X6, how much you invested? How much you invested in this instrument? 32 million. Let me check again. Yes, it's 32. So your initially your loan asset your loan asset is 32 million. Initially your loan asset is 32 million. Your loan asset is 32 million. Initially your loan asset is 32 million. Now, do you know the interest income rate? Yes, it's 3.9%. So for the whole first year, we have invested 32 million, so it's 3.9%. 32 multiplied by 3.9% is, I think, 32 multiplied by 3.9% is 1.25. Yes, this is going to be 1.25 million. So 32 and 1.25 will be added. And how much cash we received this year? 8.8. Yes, we receive 8.8. So can you take the difference? It will be 24.45, right? So keep this number in your mind. At the year end, at the year end, at the year end means the date of reversal of impairment. At the year end means the date at which we are going to do reversal of impairment. Reversal of impairment. Our carrying value, the existing carrying value is 24.45. Existing carrying value is 24.45. Okay, so this thing you have done. And yes, one more thing, let's make the entry. Let's make the entry of these two transactions. If you want, you can make separate entries like this. Wait, for this first entries, for this 1.25, the entry will be loan asset debit 1.25 and interest income. It is interest income. You can also write PNL, it's perfect. 1.25. And then definitely the other party gives you 8.8 million, so definitely your loan receivable will be reduced. Your loan receivable will be reduced because you are getting money back. So that this will be bank debit 8.8 and loan asset credit 8.8. Now these are two separate entries which you can make. And if you don't want to make these two separate entries, you can make one combined entry. See, compound entry. Hope you have heard about the compound entry. So you can mix these two entries and net it off. You can mix these two entry and net it off. That's also perfect. That's also perfect. Okay, so still I have not started the real impairment thing. Still I have not started the real impairment thing, right? That's I have to do. Now how to do it? Listen, listen. See, we are right now at 31st December's X6. This first year has been passed. This first year has been passed. We are right now at 31st December X6. Okay. Now just compare two things. Let me move the screen. Just compare to this. See, this is the main screen. This is the real screen. Just compare two things. What we were expecting, this and this, these three, 8.8, 8.8 and 8. And what are the revised cash flows? They are 10, 10, 10. So just simply calculate the present values of these two and you will get the reversal of impairment gain. You will get the reversal of impairment gain. Okay. Now, and one more thing, all these discounting is to be done. All these discounting is to be done using effective, original effective interest rate, right? This credit adjusted effective interest rate. Okay. So just think, this is December X7, X8, X9. So previously you were expecting 8.8, 8.8, 8.8, and now it's 10, 10 and 10. So what you have to do is you have to calculate present value of first these three 8.8, and then you need to calculate present value of 10, 10 and 10. Okay, and the difference will be your reversal of impairment. The difference will be your reversal of impairment. Let me calculate. See. So original expected cash flows present value. Okay, original expected cash flows present value. So it will be 8.8, 8.8 and 8.8. Okay, this is your first, wait, this is your cash flows column, this is discount factor column, and then finally present value column. Okay, now cash flows are 8.8, 8.8 and 8.8. Discount factor for 3.9%. You need to apply the formula 1 divided by 1 plus r power n. 1 divided by 1 plus I or 1 plus r power n. Okay, right? So an interest rate in this question is 3.9%. Now I'm going to write directly. You can do it with your calculator, or normally sometime examiner gives you ready-made discount factor as well. Sometimes or many times examiner gives you ready-made. So for year 1 the discount factor is 0.962. Year 2 the discount factor is 0.926. Year 3 it's going to be 0.892. Okay, right? So I have just told you this discount factor at 3 point. You can do it with your calculator as well. This cash flow we'll be receiving at December x7. This is to be received on December x8, and this is December x9. So let's simply you multiply it. So 8.8 into 0.8962, this will be 8.47. This is okay. Then we have 8.15, and then we have, be careful, be active, be active. Then we have the last one, which is 7.85. So if you add these three, it will become 24.47, 24.47. Now let me show you a magic. This is the magic. See, this answer is 24.47 using the original cash flows, so it is almost very closely same as 24.45. See, 20, because this original please give energy. This original calculation is also based using 8.8. This original calculation is also based using 8.8 million, and we are just doing unwinding. Now we are just doing unwinding. Okay, so see, it's very close to this 24.45 and 24.47. So first we have, in order to calculate reversal of impairment, first we have calculated the present value using original cash flows, okay. Now we are going to calculate present value using revised cash flows, okay. So revised cash flows are simple. It's December x7, x8, x9. It's 10, 10 and 10. Now you have the same discount factor at 3.9%. Definitely same 0.962, 0.926, 0.892. So if you multiply it, so it will be 9.62, 9.62. Then we have 9.26. Then we have 8.92. So if you add these three, this will be 27.80. 27.80. Now with open eyes, you can see, I just told you the reversal. The original expectation was this, and the revised expectation is this. So how much it is going up? Can you tell me how much it is going up? So The reversal of impairment will be 24.47 minus 27.80. 24.47 minus 27.80. 24.47 minus 27.80 will be your reversal of impairment. Reversal of impairment. Okay. Let me use the calculator. So it will be like 3.34. The reversal of impairment, or you call it impairment gain, will be 27.80 minus 24.47. 24.7, this will be 3.34. Okay. So now wait. You remember in this topic, as let me show you the, we have calculated the reversal. Finally we have calculated. But as you see the words. Jacinta company correctly calculates the loss allowance. That means they are in routine of making loss allowance. Okay, they are in routine of making loss allowance. So we need to now, in the reverse side, what is the normal entry for expense of loss allowance? Now wait. The normal entry for expense of loss allowance is P&L debit and loss allowance, or you call it allowance for receivable, as you wish, whatever name you want to give. So P&L debit and loss allowance credit. Now allowance, when allowance increases, it goes on the credit side, as it is the contra asset. So it goes on the credit side. But in this question, see, this is expense, this is normal expense, impairment expense. But now if we do reversal of impairment, so the entry will be totally reversed, because now we have to book income. Now we need to book income. So the entry here will be loss allowance debit 3.34 and P&L credit 3.34. Okay, this is your reversal entry. Okay, right? Now they are asking you what to be reported where. Let's read the requirement. They are asking you, see, this is the requirement of 8 marks. Explain how Jacinta company should account for the credit impaired loans in the financial statement for the year ended 31st December X6. Okay, your answer should include journal entries. So we have already included the journal entries. Now if you want to tell me how much income we have, so we have this income, see, we have already accounted for here. So this is 1.25 income, and then we have reversal of impairment income, that means impairment gain income. So two incomes we'll be reporting, and number two, by the year end, see, this is the normal accounting. By the year end, your closing loan asset will be, by the year end, your closing loan asset will be 24.45. Your closing loan asset will be 24.45. Okay, so this will go in the SOFP as a non-current asset. And again, the last thing is loss allowance. There is a debit balance in the loss allowance. The debit balance of the loss allowance will also go to SOFP, right? So these are the things which needs to be reported. Okay. Now, as you all know, you have to solve this question and send me. So I'm giving you a little hint about it. Like in the starting, you need to write a little bit about IFRS 9. In this question, in the starting, you need to write little bit about IFRS 9 impairment loss model, the expected loss model. That in expected loss model, we don't wait for the final event. We just book things from the using expectation model. Using expectation model, like if there is some changes in the future expected cash flows, we immediately start booking impairment. We immediately start booking impairment. Okay, right? And there are three stages: stage 1, stage 2, and stage 3. Stage 1, stage 2, and stage 3. For stage 1 and 2 we will be booking allowance, and for stage 3 it's like bad debts written off. Okay, then in application you need to tell that as this Jakarta, what is the name of the company? Jacinta, sorry. Yes, Jacinta. As Jacinta company has already bought a credit impaired loan, So that's why Jacinta company has already paid the less price. So this less price already includes the impairment. So that means already one impairment has already booked at initial recognition. One impairment is automatically booked at initial recognition. Okay, right? And then later on we have to book reversal of impairment. And for this reversal of impairment, these are the workings which you need to show. And you have to write one line that the reversal of impairment will be the difference between present value of original expected cash flows and revised expected cash flows. Very simple. Okay, right? So this was the 8 marks requirement. Now be practical. Don't fly in the air, please. Be practical. This area is like question number 3, the section B of your exam. So normally it comes difficult, and in the examination room you have tension as well. You have to run fast because it's time bounded paper. Right now we don't have any timing issue, we are free. So in exam, if you score 4 to 5 marks, that's very good. 4 marks is also very good for this question. Okay, at least you can do something. You have taken classes. You have to write in your own words. These are the real life issues, so you need to write in your own words. Okay, now the next question is very, very, very simple, I must say. It's logical and simple, which is IFRS 15. The next part is IFRS 15. See this. Very excellent. We can do a very good discussion on it. Okay, on 1st of January X6, Jacinta company entered into a contract to provide Sayer company, this is the customer, Jacinta is seller, Sayer is the buyer, with an internet service for 2 years. The contract price was agreed for 2 million, which was received in full on 1st of January X6. Now wait, no need to read forward. This is the first issue, and it is like 1.5 marks something. This is the first issue. Now wait, first of all, this is service. Now how you will write in the examination, what is the requirement? Let me show you the requirement. This is the 10 marks requirement. Okay, explain how the revenue from the internet service contract and the sale of equipment of Sayer company should be accounted for in accordance with IFRS 15. Okay, so there are two areas here. First we are providing internet service. And number two, there is a sale of equipment, which is a different thing. First, purely I am guiding you for internet service. So they are saying that they are providing internet service. Now how to book revenue? It's about stage 5. You know this famous dialogue that revenue is booked. The famous dialogue is revenue is booked when performance obligation is satisfied. Revenue is booked when performance obligation is satisfied, right? So there are two cases of booking revenue. One is point in time, and the second is overtime. Okay, so when I taught you, and whenever you have studied overtime, so if you want to book revenue overtime, there are few conditions, and you have to meet only one of them. And one condition was if you are providing a service, if you are providing a service in which the other party, the buyer, is getting the benefit simultaneously, like I'm giving you service, the other party is getting benefit immediately. For example, teaching. Hope I gave you the example of teaching. As teacher teaches, it transmits the knowledge to the student, so student gets benefit immediately, simultaneously, right? Okay. Similarly, you have taken 1 year gym membership, so if you go and do gym daily, so daily you will get the benefit. Okay. So in such cases, in such cases we will book revenue over time. So same is the case with internet service. If somebody is providing internet service, so daily the other party will get the benefit. So overtime is perfect. So overtime revenue booking is perfect. Okay. Overtime revenue booking is perfect, but there is an issue. We received complete 2 years amount now. So the first, immediately we'll be making entry, bank debit 2 million. Okay. And contract liability, you can also call it deferred income. In old books we used to teach you with the name of deferred income. Okay. So now how we'll do it, this is year 0, this is year 1, and this is year 2. So in the first year we'll be booking one income, and in the second year one income. Okay. In the year 1, we'll we'll transfer to the half of the amount in the P&L as an income revenue, and in the second year we'll book $1 million, because it's overtime. It's overtime. I let me say in Urdu, ये 2 साल का हमें 2 मिलियन मिला है, 2 साल का 2 मिलियन मिला है, तो एक एक हर साल 1 मिलियन का रेवेन्यू बुक हो जाएगा ओवर टाइम. One extra thing which you, if you want to do one extra thing, I think examiner has not discussed that thing, but you can do it because we teach this thing in class. Whenever you receive advance amount according to new IFRS 15, whenever you receive advance amount, you can book it as a loan. You can book it as a loan, and on that amount you can book an interest. You can book an interest expense. It's like you have taken loan. So this amount will be treated as a loan, right? And you can book interest expense on it. But right now I won't recommend you here. Why? Let's see your sharpness, activeness of your mind. Because if you remember, I taught you one case in the class, that you receive money now and you are giving service after 2 years. You receiving money now and you are providing goods after 2 years. In such a case, in such a case, the loan thing is perfect. But as we have started giving services from now, we just receive cash and we have started giving services, so it's better you don't book that interest expense. Okay. That's why examiner has also not discussed, so it's better not to discuss that issue. Okay. But just for your memory, I have recalled it, right? So it's better not to write the irrelevant stuff. So this was like, I would say, out of 10 marks, the 3 mark discussion we have just done, or 2.5 marks discussion. Okay. Now there is a very interesting discussion from here. Please, this is your paper. This is your paper. You have to take interest. You have no other option. You need to take interest. At the same date, Jacinta company sold equipment to Sayer company to its fair value of 500. Fair value, it's fair, means it's a fair sale. No game. At the end of the internet service contract on 31st December X7, Sayer company has the right, means customer, Sayer companies has the right to return the equipment to Jacinta company and receive 20,000. Okay. Jacinta company anticipates that the equipment's fair value will be 75,000 in 2 years time. Now tell me, wait. This is year 0. This is year 2. Today I sold the product, and I have asked my customer, that if you guys want, you can just come and throw me the product. I'll return you 20,000. You can return me. You have the right to return. You have the right to send me return for 20,000. Okay. But the expected fair value at the end of year 2 is 75,000. Now, do you think the customer is fool? No, the customer is not fool. Why would customer return? Just think, why would customer return to me when he can sell this thing for 75,000 in the market? When he can sell these things for 75,000 in the market, why would he return this to me for 20,000? Why would he return this to me for 20,000? So that means there are no chances of return. There are no chances of return. Let me speak this in Urdu language, Hindi language. भाई जब मार्केट में उसका 75 का बिक रहा है तो वो मेरे पास 20,000 में क्यों बेचेगा आके? वो कभी भी नहीं आएगा मेरे पास. तो ये ऐसा राइट है जो एक्साइज ही नहीं होगा. ये ऐसा राइट है जो एक्साइज ही नहीं होगा, दिखावे का है, कुछ नहीं है. इट्स नॉट रियल. Okay, so that means it's a genuine sale. It's a genuine sale. It's gone. Now, one more thing, one more very good news. The market for second-hand equipment is very strong, and share company would be able to sell the equipment easily at the end of 2-year agreement. Yes. So it's better share company can go to the second-hand market and sell it for 75. Share company will not come to us. This is again second evidence, second evidence. See, we have to pick evidence. It's like I sometimes say that SBR questions are like court cases. You have to pick the evidence, right? Now, Jacinta company does not want to deal in second-hand equipment and therefore always prices equipment returns at an amount substantially below fair value. Now, one more thing, Jacinta company also don't want anybody to return. Jacinta company also don't want any customer to return. That's why they fix the deal. They set the numbers like that the price that the return price will be will be less than fair value. So nobody will come. That the return price will be less than fair value. So nobody will come. Are you getting? So that means there is no chance of coming back. So it's a genuine sale. Yes, it's the goods are sold. The equipment is sold. Share company has never returned equipment to in the past. See, one more evidence. You guys are auditors. You guys are auditors. You guys are real auditors. Okay, you have done ACCA part 2. So in audit, past evidence is a big thing. Past evidence is a big thing. So there is no past. In past, share company has not returned. So that means yes, it's a genuine sale. And as the equipment, listen, are you getting? As the equipment is a single product, it's a one-off thing. You transfer control immediately. You transfer control in one shot. So we book revenue point in time. We book revenue point in time. We book revenue for such things as point in time. Okay, right? So now how are you going to write it? Let me give you a little description. First of all, you need to directly discuss this issue, that this is the sale, this is the question of sale with right to return. So now in such a case, we will see the expectation that whether the customer will exercise this right or not. So customer will only exercise this right of return if there is an incentive. If there is an incentive to return. And that incentive is normally calculated by checking the fair value and the return price. Fair value and the return price. So in this question we have seen. So this is the rule, the beginning part. Then you can also write, if it is highly expected that customer will return, that means the incentive is very good. Like for example, the fair value is 50,000 and the return price is 90,000. So customer will definitely return. So in that case, you have given, let us say the life of asset is 10 years. Let us say the life of asset, the life is 10 years. And see, this is the deal. Return price is, let us say 150,000. Just I'm changing. Today I sold it at year 0. At the end, original life of this product is 10 years. At the end of year 2, customer has right to return it to me At that date, the fair value is 75, but the return price is 150. So now when there is such a good incentive, when it's such a good incentive, customer would definitely return to us. So that means out of 10 years, just 2 years customer use, just 2 years customer use. So that means customer has not taken the substantial benefit. So in this case, we will treat it as if we have provided asset on lease to customer. We have provided this asset on lease to customer. Okay, but in this question, this is not the case. In this question, the case is this, that at the end of year 2 the fair value will be 75 and the return price is only 20,000. So it clearly says customer will never return, so it's gone. It's a genuine sale. You can book the sale, and also we have seen the second hand market is very active, so customer can sell it in the second hand market. Now what are the final wordings in the end? The final wording is the end that you can book revenue as point in time of 500,000. See, this is 500,000, you can see, right, of 500,000 less any expected return liability. But in this question there is no chances of return, so return liability will be zero. There is no chances of return because fair value is higher and return amount is lower. So you will write in normal circumstances with in such a case that you have done sale with right to return, so in that case the sale is booked with the complete amount, and we will be booking a liability for right to return. But in this question the right to return chances is nil. लेट मी से इन उर्दू, भाई राइट टू रिटर्न के होने के चांसेस ही नहीं होंगे, सामने वाला क्यों वापस करेगा, 75,000 में मार्केट में बेच देगा, हमें क्यों करेगा? तो यहाँ तो रिटर्न लाइबिलिटी जीरो है। लेकिन रियल लाइफ में, इन रियल लाइफ you need to book that return liability, and it is revised every year according to circumstances. Okay, so I would request you to note down these points. With the points which I just told you, try to note down because you have to send me for marking. Okay, now we are moving towards the last part of this question. Okay, so this is the part. See, let me enlarge it. Not difficult, just the ending point is technical. So sale of inventories to overseas subsidiary, that means a different currency will be involved. Now be careful. On 1st September x6, this is the, you can call it the mid of the year or the beginning of the year, right? Okay, once again let's see the accounting year end. Your accounting year end is 31st December x6. Okay, so that means 3 to 4 months before the year end. On 1st September x6, Jacinta is parent, P company, sold inventories costing 1.35 million to a wholly owned overseas subsidiary for $2 million. There is no right to return. That's a pure sale. That's a big pure sale. Okay, so for parent company, now in this question you have to discuss three areas. Number one, P company's individual books. Number two, S company's individual books. And number three, consolidated books. That's it. You need to discuss this transaction for three books: parent company individual books, S company's individual books, and consolidated books. Very simple. Okay, so now parent company's functional currency, we have read. Let me show you again. See, it is written here. Yes, it is written here that the pair, yes, Jacinta company is dollar, parent company is functional currency, presentation currency, everything is dollar. Very simple, like a normal question of foreign subsidiary, that your in as your paper is international, so parent company will always be earning in dollars. Okay, so it's dollar. So now just think, parent company currency is dollar and parent company sold in dollars, so it will be normal entries for parent company. Now I'm just going to discuss the issue with for you for parent company. Listen, as the parent company's currency is dollar and parent company sold in dollars, so parent company will be making his books in dollars. So normal, parent company just did a sales, so parent company will be booking a sales of $2 million, normal. Cash sales or credit sales, they have not written anything, so it's, you have to write in exam that first you will be giving heading of parent company's individual books. In parent company's individual books, parent company will be doing sales of $2 million, number one, and parent company will be booking cost of $1.35 million. So ultimately the profit is $0.65 million. The profit to P company is $0.65 million. Now, right now we are talking about individual books, so there should be no discussion of unrealized profit here. For parent company individual books, it's a realized profit, it's a normal profit. So parent company sold goods to S company, so you need to write, these are easy marks, easy cash marks. In parent company's individual books, parent company will be booking sales of $2 million because parent company's currency is dollar and the sale is also in dollar. Parent company will be booking cost of sales of $1.35 million. Yes, okay. So automatically a profit of $0.65 million will be booked by parent company. No more discussion of unrealized profit now, because individual book has nothing to do. Individual books has nothing to do with unrealized profit. Now, the second thing is S company's individual books. Second thing is S company's individual books. Definitely S companies. Now let's read. The subsidiary company has the euro functional currency. Now for individual books of S company, these books are in euros. These books are in euros. So don't think about unrealized profit right now. I'm again talking about individual books of S company. I'm again talking about individual books of S company. Okay. So, and the individual books of S companies are in euros. So the exchange rate on the date of the sale from the Jacinta company to overseas subsidiary is $1 to 1.25. That means $1 is equal to 1.25 euros. Now, these all discussion, listen, this part is linked to only consolidation. We don't have to do anything for consolidation now. So from subsidiary company's point of view, subsidiary company has just bought goods for $2 million. Subsidiary company has just got book goods of $2 million. So subsidiary company will be converting in its own currency at the exchange rate of that date. So $1 is equal to 1.25. So similarly, it will be like this. Listen, $1 is equal to 1.25 euro. So you are going from dollars to euros, your dollar to euro. So a big number will come for euro. Definitely a big number will come for euro. So you will multiply. So it will be 2 million multiplied by 1.25. So 2.5 million euros. Parent company, sorry, S company will be booking purchases of 2.5 million euros. S companies will be booking purchases of 2.5 million euros. But yes, you just need to highlight and identify that what is the cost of this for the group. The cost of this inventory is $1.35 million. The cost of these are $1.35 million. So let's convert this cost into euros at this exchange rate. So 1.35, let me do it here. Requirement C. For S company individual books, right? Bought for $2 million, and now $2 million, now convert it. 2 multiplied by 1.25 is 2.5 million euros. Okay, so this is the cost of purchase for S company. Now, what about the cost of these goods for the group? Let me tell you. 1.35 million was the original cost, multiplied by the exchange rate is 1.25. So 1.35 into 1.25 is 1687 million euros. If you want, you can write it like this in exact zeros, and it will be 6 more zeros, so it will be 1687000. It's your wish. If you want to do it, this is also in million and this is also in million. Okay, so now how much profit, how much profit? Obviously just think, parent company bought goods at a lower rate and sold at a higher rate, so that there is parent company earned profit, or you call it parent company sold these goods to S company on an expensive rate, so some profit, some intra-group profit is booked in the S company's books. Okay, so intra-group profit book in the books of S company. S company's inventory is, just think, what was the profit? It was 0.65 million. Definitely 1.35 minus 2 minus 1.35, 2 million was the selling price for P company. Cost for P company is 1.35, so 0.65 million is the $0.65 million is the profit. Now multiply it, please. Multiply by the exchange rate is 1.25, so 0.65 into 1.25 is will be 0.8125 million. Okay, euros. So this is the profit, this is the profit. And yes, if these goods are not sold by, completely sold by S company at the year end, then this will be your unrealized profit as well. But right now we are just discussing individual books. So parent company's individual books are super easy, super easy, because parent company's currency is dollar and parent company did sale in dollars, so parent company will simply book in dollars, as I discussed. Now S company's individual books again is very simple. S company's individual books, I'm not talking about consolidated books, that's the last area. So for S company's individual books, S company's currency is euro. So whatever exchange rate at the date of buying, S company will convert it. So this is the cost bought for $2 million, means 2.5 million euros. But now what about the cost? Because parent S company bought it on expensive rate. So what about the cost of these goods for the group? So the cost was 1.35 million for the group. So 1.35 into 1.25, the exchange rate, this is the cost, and the difference is profit. You can write in exact zeros as well. So these are the two individual books which you have discussed. This part was easy, as the last part is difficult. Last part is difficult, or I must say the last part is difficult, or I must say that in the last part you must have knowledge of foreign subsidiary. There are students, they do shake in foreign subsidiary, they have some issues with foreign subsidiary, but still I never say to you guys to score 100 marks, and nobody of you do. So it's okay if you, there are three areas to discuss, and if you do mistake in one area, it's perfectly okay. This should be your approach. So now the last books are consolidated books. The last books are consolidated books. Please be very careful. Now this is P company. Wait, this is S company, right? Now P company sold. Let me read the question first for you. This is the question. Take your time, please. Take your time. Now, at 31st December X6, the subsidiary still holds the goods in inventory. Still hold means all the goods are in inventory, okay? And the exchange rate at the year end is this. No tension, no tension, please. There is no intercompany debt outstanding at the year end. That means there is no receivable, payable outstanding. No need to do any cancellation thing, okay? Now, it's okay in the SOFP, you are not going to cancel it. But yes, for income statement, consolidated income statement, parent company sold goods to S company and S company bought goods. So in income statement, whenever there is a P to S sale, in income statement, whenever there is a P to S sale, there are always two steps. I taught you guys since beginning, like from F3 level, FA level, then F7 FR level, I teach this. In SBR you also know, if there is a P to S sale and the question is of income statement, you do two steps. The first step is consolidated sales and cost of sales are knocked off with the amount of transaction. Consolidated sales and cost of sales will be knocked off by the amount of sales done by P company. Number two step, the unrealized profit will be added back in consolidated cost of sales. So these easy steps you can write. Still, there is no difficulty. It's a P2S sale, very simple. P2S sale, and whenever you do P2S sale in income statement, there are two steps. In consolidated income statement, P2S sale has just two steps. Number one, reduce the sales and cost of sales with the amount of transaction, right? And then add URP in cost of sales. So let me discuss. For consolidated SOCI, consolidated sales and cost of sales will be reduced by the amount of transaction. First step, then URP, the complete amount is URP, will be added in consolidated cost of sales. Consolidated cost of sales, in consolidated cost of sales. Okay, so these are the very easy steps, but yes, the last thing is left for SOFP, and that is exchange gain or loss. Exchange gain or loss of net assets of S company. Now one last thing, one last thing. Let me recall you first. Let me recall you. See, hope you remember whenever you used to do foreign subsidiary, you need to you are required to calculate exchange gain or loss on foreign operation. Remember, exchange gain or loss on foreign operation, and in that exchange gain or loss on foreign operation you used to calculate exchange gain or loss on net assets. I recall you. Let me recall you foreign subsidiary. Please relax. In foreign subsidiary, you used to calculate foreign exchange gain or loss on goodwill. Here you don't need to calculate goodwill thing because goodwill is not given, and this is the this question is not about goodwill. This question is not about goodwill discussion, so remove it. But normally we do in foreign subsidiary. Please, I have taught you. Number two, you used to calculate foreign exchange gain or loss on net asset. Net asset means on complete subsidiary. And best example is, just think, let us say I am in Pakistan and I have bought a company in United States. So right now when I bought the company means bought the subsidiary means complete running business, including all assets. So right now I bought it for one lakh dollar. For example, $100,000 I bought it. Right now the exchange rate is rupees 100 per dollar. Now what if at the year end the exchange rate becomes 150 per dollar? So definitely the worth of my business change in terms of Pakistani currency, because I invested in foreign subsidiary when the exchange rate was rupees 100, but now the exchange rate is 150. So for all the assets of S company, or we say for the net assets of S company, the exchange rate, there will be some exchange gain or loss on net assets. Let me say this in Urdu language or Hindi language. देखो, जब हमने सब्सिडरी खरीदी थी तो उसके सारे एसेट्स खरीदे थे ना, सारे सब कुछ खरीदा था, तो उस वक्त कुछ एक्सचेंज रेट और था, तो हमने एक एक्सचेंज रेट पे बाय किया था, लेकिन ईयर एंड पर एक्सचेंज रेट चेंज हो गया। तो अब क्या होगा? एक्सचेंज रेट चेंज होने की वजह से हमारा एक्सचेंज गेन और लॉस ऑन नेट एसेट आता था जो आप निकालते थे सब्सिडरी में, फॉरेन सब्सिडरी पढ़ते वक्त। तो जिस तरह आप वो निकालते थे, तो अभी भी आप वही कैलकुलेट करोगे। अब एक एसेट पे निकालोगे इन्वेंटोरी, देयर इज ओनली वन एसेट, इन्वेंटोरी। Now let me come back to English. So you have only one asset in this question, and that is inventory. So inventory was here, and as well as at 31st December x6. At both places we have inventory, and this inventory is not sold. Now wait. But for the purpose of group, we are talking now, we are in group accounts. See the heading, we are in group accounts. For the purpose of group, we need to remove the unrealized profit, and we always remove. So now this inventory will be recorded on the cost of P company, the original cost of P company, which is the cost of group, and that was $1.35 million. Okay, $1.35 million. This is the original cost of this inventory for parent company. So this cost does not include the unrealized profit. That means this cost, in this cost there is no effect of URP, and for the group purpose we never show inventory with URP. We show inventory with the removal of URP. So this is pure inventory. Okay. Now, first of all, what we did when you bought it, you converted it into the exchange rate. The exchange rate was here $1 to 1.25. 1.25. Now wait, so this will be, if you convert it, so this will become 1687,500. 1687,500. This will become 1687,500 euros. Or I've already converted it, or you call it 1.6875 millions euros, your wish. I have written with all zeros. You can also write it as 1.6875 million euros. Okay, so this was your inventory at the beginning of the year. This was your inventory at the beginning of the year in euros, and this was in dollars. Now, at the year end, wait, this inventory was not sold. So that means this inventory is still at 168,750 euros. But the real investor is parent company. The real investor is parent company, and the presentation currency for parent company is dollars. You forgot everything. My dear student, we prepare foreign subsidiary consolidated books on the basis of parent company's currency. Remember everything. Year at the year end, we do add together in dollars. So now at the year end, the exchange rate is the exchange rate is $1 is equal to 1.3 euro. $1 is equal to 1.3 euros, right? Yes, this is the rate. Okay, so can you convert these euros into dollars? Can you convert these euros into dollars? So 1687500. Now we are going to from euro to dollars. Euro to dollars. Euro is 1.3. Euro is equal to $1. So do divide. So this will be, wait, 1687500 divided by 1.3. 1687500 divided by 1.3, it will be 1,298,077 dollars. 1,298,077 dollars. Now wait, and this was 1.35 million. Let me remove the million sign. Let me do it with complete zero so that it will be easy. So it will be 1,350,000. Now think over it. When you invested, when parent company invested in subsidiary companies, one of the asset had a value of 1.35. Go in dollars, think in dollars, because final consolidation you have to do in dollars. Foreign subsidiary consolidation you do in dollars. So in the consolidated books, when parent company invested in S company, at the beginning time, the value of S company's asset was 1.35 million, because now this asset belongs to S company, and at the year end the value of this asset becomes 1,298,007. So the value of asset fell down in terms of dollar because of exchange rate game. Because of exchange rate changes, the value in dollars of this asset falls. So there is an exchange loss. Let me tell you the difference. How much is the exchange loss? Exchange loss is 1,350 minus 1,298,077. Let me change the color. This will be 51923. 51923. This is your exchange loss. Now use your brain. This is your exchange loss. Let me say in Urdu language now, Hindi language. जब हमने स्टार्टिंग में इस सब्सिडरी को ख़रीदा था, तो सब्सिडरी का ये एसेट डॉलर टर्म्स में सब्सिडरी के पास चले गया, तो हम तो डॉलर में ही सोचेंगे ना, पेरेंट कंपनी तो डॉलर वाला इन्वेस्टर है, तो डॉलर टर्म में ईयर के स्टार्टिंग में 1,350,000 का था, और ईयर के एंड पे वही चीज़ डॉलर टर्म्स में हो गई है 1,298,077. तो डॉलर टर्म में एक्सचेंज लॉस हुआ है ना, सोचो, वही निकाल दिया. नाउ फाइनल थिंग. नाउ टेल मी, exchange gain or loss on foreign operation goes in OCI. Now hope you remember my dialogue. Exchange gain or loss on foreign operations goes in OCI now, but when this subsidiary will be sold later, it will be transferred to PNL. It will be transferred to PNL. It will be transferred to PNL. Okay. So this will be reported. This will be reported in OCI now, but later when it when this subsidiary will be sold, it will go in PNL. The routine thing. Okay. Sometimes we call it translation reserve as well. Sometimes we call it translation reserve as well. Okay. So now be practical. Be practical. Accept the realities. Accept the realities. Don't fly. Don't fly without wings. Please. In this question, what you can do easily. I'm telling you the examiner feedback. You can easily do parent companies individual books discussion, S companies individual books discussion you can do, but yes, this consolidated books discussion, especially this last part, was technical. Normally everybody cannot do. Some people can do like 50%, 40%, 30% and like that, or you can do your suggested solution. And do accept this reality. In examination you give suggested solution, suggested solution, but still examiner do lenient checking because this paper is very practical, very practical. And there is a headroom. You know the meaning of headroom? Like there is a 10 marks question. 10 marks is the given marks, so examiner will start checking with 16 marks. Examiner will assume that the question is of 16 marks, and if you do 6 marks mistake, still you will get complete 10 marks. So this is the leniency of in checking. Okay, that's why normally students clear. So be practical now. My request is and my order is, please, my order is, solve this question yourself formally on the software and then save it on PDF and send me for marking. For my registered students, we are going to mark it. Okay, right? So please do it, and hope you understood it. And now that's the end of the class. I'll share this all slides with you. Okay, thank you and take care.